This is part 3 of the Chapter 4 lecture series on adjusting entries, specifically on accruals. Let's get started. In the last video, we focused on the first type of adjusting entries, deferrals. In this video, we are going to learn about the second type, accruals. Remember, an accrual in general results when we have earned a revenue or incurred an expense before we receive or pay cash. There are two types of accruals, accrued revenues and accrued expenses. Accrued revenues occur when a company earns a revenue before cash is received. Accrued expenses occur when a company incurs an expense before it pays for the expense. Now let's talk about the specifics of accrued expenses. Again, a company earns a revenue before the customer pays. If the transaction hasn't been recognized through a general journal entry, then we need to prepare an adjusting entry to record it. The adjusting entry would involve a debit to an asset account, such as accounts receivable, and a credit to the applicable revenue account, such as service revenue. As an example, in October, Sierra performed guide services for $200 that were not billed to clients before October. Because the customers were not billed until November, Sierra didn't prepare a general journal entry to record this transaction. However, this revenue must be recorded in October because Sierra performed the services and therefore earned the revenue in October. So we should prepare an adjusting entry that involves a debit to accounts receivable for $200 to recognize the fact that customers owe Sierra money, and credit service revenue to recognize the revenue that Sierra earned. Now let's talk about the specifics of accrued expenses. Again, a company incurs an expense but hasn't paid for it yet. If the transaction hasn't been recognized through a general journal entry, then we need to prepare an adjusting entry to record it. The adjusting entry would involve a debit to an expense account to recognize the incurrence of the expense, and a credit to a liability account to recognize the obligation to pay. Let's look at a couple of examples for Sierra. A common example of an accrued expense is interest expense incurred on a note. Remember from Chapter 3 that Sierra signed a 3-month note payable in the amount of $5,000 on October the 1st. The note requires that Sierra pay interest at an annual rate of 12%. With a note, the person borrowing the money doesn't pay anything until the note matures. There are no periodic payments of interest or principal. So Sierra won't pay anything related to this note until January the 1st. The question is, does Sierra owe interest on the note at October 31st, even though they aren't paying any interest until January the 1st? The answer is absolutely. Think about it like this. If Sierra were to pay off this note early on October 31st, do you think the bank would accept just $5,000? Of course not. They would expect the $5,000 principal plus the accrued interest. So even though Sierra isn't paying interest until January, it must accrue the interest that they owe at October 31st to recognize the expense incurred during the month and the obligation to pay. Our calculation of interest is principal times rate times time. The principal in this example is $5,000, the rate is 12%, and the time factor is 1/12. This time factor is required because if we simply multiplied $5,000 by 12%, we would calculate the interest that Sierra would pay if they had the money for an entire year. The 12 in the denominator represents 12 months in a year, and the 1 in the numerator represents 1 month, the month of October. If we wanted to calculate the total interest that Sierra will pay on the note, the time factor would be 3/12. When you do the math, you'll see that the interest for the month of October is $50. So we would need to debit interest expense for $50 to recognize the expense incurred, and we would credit interest payable to recognize the obligation to pay. Make sure to credit interest payable. We do not credit notes payable. Notes payable is used only for the principal of the note. Another common example of accrued expenses is salaries and wages. Let's look at an example for Sierra. Sierra Corporation last paid salaries on October 26th. The next payment of salaries will not occur until November the 9th. The employees received total salaries of $2,000 for a 5-day work week, or $400 per day. Remember, our goal is to get all expenses related to October recorded in October. Employees worked 3 days in October that they won't be paid for until November, but we must recognize the expense that we incurred for those 3 days. The employees earned $400 per day. They worked 3 days, so the total expense that we need to accrue is $1,200. We would debit salaries and wages expense to recognize the incurrence of the expense, and we would credit salaries and wages payable to recognize the obligation to pay the employees. This completes Part 3 of the Chapter 4 lecture series on accruals. Now let's learn the remaining steps of the accounting cycle.